Welcome to Lesson 2. Today we'll learn about the most powerful principle in investing, the power of compound interest. Once you understand compounding, the question of why start early becomes visible in hard numbers. This is exactly why the wealthy have emphasized compounding throughout history. It's why long-term investors came out ahead after the 2008 financial crisis, and it's why Warren Buffett has long said that time is the friend of the wonderful investor. If you're in your 20s or 30s, this lesson matters even more because time is your single biggest asset. Let's walk through it together, step by step. Just like the Apple chart on screen, we can watch how money changes over time. Let's first understand the difference between simple and compound interest. Simple interest only ever accrues on the principal. $10,000 at 10% simple interest earns $1,000 in year 1, another $1,000 in year 2, exactly $1,000 every single year. After 10 years, you have your $10,000 plus another $10,000, $20,000. A straight line. Compound interest is different. The interest gets added back to the principal, and the next round of interest is calculated on that larger amount. Year 1 earns $1,000, but year 2 earns 10% on $11,000, another $1,100, and so on. Same terms, $10,000 at 10% compound interest, and after 10 years you'd have roughly $25,900. That's about $5,900 more than simple interest, almost 30% or more. It's like rolling a small snowball down a hill. At first it's slow, but as time passes it grows explosively. That is the magic of compounding. There's a shortcut for measuring compounding's power. It's used in finance textbooks, and it's called the Rule of 72. It's simple. Divide 72 by your annual return, and you get the number of years it takes for your principal to double. 포뮬라 72 나누기 사인 리턴 % years to double. It on 8% annual return 72 나누기 사인 89 years. It 6% 72 나누기 사인 62 years. It 4% 72 나누기 사인 48 years. Try the math yourself. Here's the key insight. A return just 2 percentage points higher, from 6% to 8%, cuts the doubling time from 12 years to 9, a full 3 years saved. That's why, in long-term investing, even a 1 or 2% difference in returns makes an enormous impact. A small gap, amplified by time over decades of compounding, becomes a huge gap. The biggest secret behind compounding is time. Let's see just how much a 10-year gap between ages 25 and 35 really matters. Invest $10,000 at age 25, let it compound at 8% a year until age 65, and it grows to roughly $217,000. 40 years of compounding. Invest the same $10,000 at age 35 instead? At age 65, you'd have about $101,000. Lose 10 years and your result is less than half. Same starting amount, same return, same finish line at age 65, and yet the outcome is more than 2x different. That is the power of time. There's a saying, the best day to start was yesterday, and the next best day is today. From a compounding standpoint, it's absolutely true. Starting today gives your money the longest possible runway to grow. Here's another uncomfortable truth about compounding. Consistency is far more powerful than a single home run. Think about it. If you make a 50% gain 1 year and then immediately suffer a 50% loss that same period, $10,000 becomes $15,000, then drops to $7,500. You're below your starting point. You can't even get back to break even easily. On the flip side, if you grind out a steady 10% a year for 30 years, your money grows to about 17.4 times the original. Historically, major indices like the S&P 500 have delivered roughly this kind of long-term return, but the future is never guaranteed. Stable returns win in the end. Investing is less about making it big all at once and more about not losing consistently. Not losing is itself the most important line of defense for compounding. A 싱글 50% 로스 requires A 100% gain just to recover. Now, let's look at how to apply this in everyday life. There are 3 principles. First, invest a small fixed amount every month on a schedule. Putting in $200 a month for 30 years is far more effective than trying to time one large lump sum. This is called dollar cost averaging, and it pairs time diversification with compounding. Second, reinvest your returns instead of spending them. When dividends or gains come in, put them straight back into your investments. Only then do those earnings compound as well. Third, minimize your losses. A 50% 로스 requires A 100% gain to recover. 100 마이너스 50 50, 옌드 50 나누기 사인 50%. Not losing while staying consistent is the core of preserving compounding. Even if you start with only a small amount today, the moment you begin is the single most powerful decision you can make to extend your compounding runway. Let's recap Lesson 2. Compounding is the snowball effect of earning interest on your interest. At the same return rate, it earns more than 30% to above simple interest. Use the rule of 72 to calculate how long it takes to double. 72 divided by return equals years. A 2% higher return cuts the doubling period by 3 years. Time is your strongest ally. Starting 10 years earlier can more than double your final result. Consistency beats the one big win. A 50% loss needs a 100% gain to recover, so the answer is steady progress without major losses. In Lesson 3, we'll learn about the types of assets, savings, bonds, stocks, commodities, and crypto. We'll see what risk each one carries and how compounding works inside them. This course is for education only. Nothing here is investment advice. All trading decisions and responsibility are yours.